Audio check, testing the audio. Audio check. Just testing the audio. Hello and welcome, everyone. Glad to have you joining in with us. We'll get started here right at the top of the hour in about 13 minutes. As the Chiron is indicating, if you'd like to take notes, don't forget to grab pad of paper, something to write with, and encourage you to grab a beverage if you would like and get settled in. We'll get started here right at the top of the hour in about 13 minutes. We won't start early, but we also will not start late. If you can let me know that the audio is working and everything's good, I wouldn't mind testing that out. You can also type a question. We will have a Q&A portion of our time together, so there should be right on the website down at the bottom a place where you could type in a question, or you could say hello, or you could tell me where you're from. I know we've had people from all over the country. Last week we had someone from Alaska, so that was exciting. I know we've had people from Hawaii in the past, but I'd be curious to know where you're from. Seemed like we had the majority of folks were from Texas last week, so I guess we'll see if we get a repeat of that. I'm in Michigan, for those of you who are wondering. Weather is cold. It's been quite low, sub freezing for sure. Ken, we'll get started. I see we have a few people that just joined in, so we will get started here in about 11 minutes. Oh, wow. We have someone from Alaska again. Wow. I always wonder if you're the same person, but that's okay either way. Now we got another Austin, Texas. All right. Yep. We've got Indiana. Okay. Great. Pennsylvania, California. On Facebook, we have somebody from Fargo, North Dakota. So very good. Oh, wow. Illinois, Houston, Texas. Wow, you guys, you all are spread out. Although I do see we have two from Texas, so maybe Texas will win again. Oregon, okay, no different. Oh, different. Oh, wow, interesting. So you're saying you didn't attend before? Yeah, we literally had someone from Alaska. I wonder if there's a lot of people retiring in Alaska these days or something. Is there something seasonal about retiring in early parts of the year in Alaska? I don't know. Oklahoma? Wow, great. Yeah, spread out all over the place. We'll get started here in about 10 minutes. For those of you who are just joining us, do encourage you to get a pad of paper, pencil, pen, whatever you'd like to grab there, and that would be great. We've got New York. Okay, great. Yeah. I see your question about being recorded. It does stay live for a limited period. And so that's for folks who maybe registered but weren't able to attend at the assigned time. But it doesn't stay up forever. So, but we typically do this workshop every week. So just join us again next week if you would like to do that. Presentation is roughly the same, unless I start to get a little bored with my own content and then I mix it up a little bit. But we're in a new year and we got some fresh updates for 2026 that we'll talk about today. So it should be nice and energetic. I did the same presentation almost verbatim for 3 years with just very minor updates. And that was okay. That was fine. But there were times where I remember I would, say like 5 minutes worth of stuff, and I would go, "Did I even talk?" And it's just, I just did that identical presentation so many times. Again, with the little updates for the new year, but I find that it's best if I keep the presentation fresh and the content fresh. Obviously, the content fresh to the new year, but even the some of the case studies and things that could roughly stay the same, I like to mix them up a little bit just to keep myself interested. Because I've been told it was good either way, but I like it more if it's not something I'm yawning through. Although if I yawn today, it's because my son. I have a how old is he? He's 5. He'll be 6 this year. Son who decided that it's cold here in Michigan, and he got a little cold last night, and he woke up a couple times because of it. So I hope not to be yawning, but if I do, that's why. Okay, we've got about 7 minutes till our start time. We're not going to start early. We're not going to start late. But if you need to do anything before we get rolling with the presentation, I encourage you to do that. Run to the restroom, grab a beverage, grab a pad of paper, pencil, pen, whatever you like to write with. I encourage you to do that. Does anyone have a temperature in their neck of the woods that is currently, right now, above 35 degrees? Anybody? I feel like it's cold everywhere right now. Everybody sub 35 degrees, or we have anyone north of that right now? I feel like our only hope at the moment are these Texas folks, unless we have some others from other parts of the woods. Although I don't, Oklahoma gets cold though, especially with all that wind that can come through there. I don't know where Davis is exactly, but I feel like Houston, maybe Houston is our best chance. Abilene can even get cold, is my memory anyway. Oh, we had yeah, that's right. Oh, there we go. We got Cartersville, Georgia, Marianne, 47 degrees. Okay. 55 in Austin. Okay, let's not, you Southern Californians with your 74 degrees, you can take that someplace else. Okay, Salt Lake City at 37. Okay, all right. All right, well, it's warmer in places than I thought it was. Okay. Yeah, 55, but still snowing. So yeah, it's just been rough. It warmed up a little bit here today. It was 4 degrees a couple days ago, and now it was 14 today. So that was great. We picked up a whole 10 degrees. Oh man! All right, we got about 5 minutes till our start time, so hang tight. We'll get started here in about 5 minutes. Yeah, see, that's what I'm talking. So North Carolina, 32. Yeah, that's just the surprising part. Yeah, that's true. Oregon at 45 degrees. You guys get insulated up there. My wife's uh my wife's grandparents are from Portland, and I mean it'll get cold, but yeah, it just seems like you just sort of get a little weather buffer, so it usually doesn't drop real cold. Oh, okay, 32 degrees in Oklahoma. All right. Southern part. Okay. Interesting. Not been to Chickasaw National Park. Yeah, New York is 19 degrees. We even got you beat here a little bit. Yeah, 9 degrees in Iowa. Yeah, tell her. Yeah, it's cold out there, isn't it? Four, 4 minutes till our start time. We'll get started, as I said, right on time. About 4 minutes to go. For those of you using the chat, we will have a Q&A portion of our time. You just use that chat when you If you have a question during the presentation, you could type it ahead early. Hopefully, I don't miss it. If I do, just type it again. I see it kind of real time. So if I happen to miss your question, you can always type it again later. Yeah, a lot of snow out there too. Yeah, I see that. Someone should have retired in Acapulco. Yeah, probably. All right. About 3 minutes to go till we get started here. If you do want to participate in the Q&A, you can do what you see other people doing. Right below the video on the web page, you can see the kind of a chat section or a Q&A, I think it's listed as. You can just type right in there and I will see your question during the Q&A portion. And then you can also, if you're on Facebook or YouTube directly, you're very welcome to type in there. I can see that as well, just on a different screen for me, but that's no big deal. Wherever you are punching things in, I can see it. So long as it's YouTube, Facebook, or on our website. I don't think we're streaming anywhere else, so that should cover us. We're going to get started here in about 2 minutes. So if you have any last second things you want to do, I encourage you to go do that. Run to the restroom, grab a pad of paper, pen, pencil, beverage, snack, whatever you need to get settled in. We will get going here in about 2 minutes. Someone's looking to retire in April and go part time somewhere else. I think that's how we all feel in this time of year. Regardless of where you are, can always get a little warmer somewhere. My granddaddy, uh, when he moved to Florida, Orlando, Florida, his boss at the time, this is back in the 1970s, his boss at the time said, I didn't think you would go to Florida. You've got all your family in Kentucky. And, for me growing up in Michigan, Kentucky was warm to me, especially in the wintertime. And so, uh, he told his boss, he said, well, his boss asked him, why did you decide to leave? And he said, I have to get away from this cold. Which, as a young fella growing up in Michigan, I thought was pretty hilarious. Okay, we're going to go ahead and get started. So, welcome to a Financial Resource Academy presentation of uh, updates to Social Security for 2026. Our official title is Retire Right, Unravel the Social Security Mystery in 1 hour. This is a slightly updated and modified presentation that we do going into the new year as we are looking at very specifically a lot of the updates and things that are important for you to know relative to your Social Security benefits. Here in 2026, some changes have happened, and those changes, obviously, especially around taxes, will affect certainly your benefits. Our presentation for today is going to go in two parts. We're going to spend right about an hour on the topic of Social Security. I'm going to do my best in that hour time frame to cover what I sort of think and know from my experience as a retirement planner are kind of the big key things that you should be knowing about, thinking about when it comes to your Social Security filing decision and how that factors into your decision making and retirement plans. Coupled in with that, right at the end of the presentation, we will go into a Q&A portion of our time together. And also, right before we lead into that, I will tell you how to request your Social Security workbook. This workbook is something that I wrote. And so I hope you enjoy it. Otherwise, I might feel a little bad. But the point is that I wrote this workbook and it's going to be made available to you. And I'll talk about how you can request it at the end of the presentation. So certainly hang tight for that. And then we will go into the Q&A portion. Uh, my name is Kyle McCauley. Want to share with you just a little bit about my background, really more than anything else, just so you have a decent understanding of my focus or thought process around this topic of Social Security And, when I'm sharing the things that we're going to talk about today, it's really coming from my experience as a retirement planner and how Social Security factors in and fits in with things like, other retirement income, your tax strategies and plans, your investment selection, and how that factors into your decision making process. That's because I'm the chief investment officer also of Entrust Investment Services, a registered investment advisor. And I am, in addition to that, a chartered retirement planning counselor. That's those fancy letters underneath my job title, an accredited portfolio management advisor, and a national Social Security advisor certified professional. Probably, in a lot of ways, for, at least our discussion today, probably the most important credential that I have. And the reason for that is Social Security law is more than 2,600 pages. It is not something you can accidentally become an expert in. Social Security is complicated, and the rules and factors that sort of surround people's Social Security filing decisions can also add layers of complexity to an already kind of complex system to begin with. So, Social Security credentialing from the National Social Security Association, it is the only accredited organization on the topic of Social Security. So, whenever you're making your Social Security filing decisions and plans, it is good that you speak with somebody who has the appropriate background and education, who can help guide you in the right direction. We are in no way employed by, nor are we affiliated with the Social Security Administration. The purpose of our presentation today is not to, help you file for benefits. That's the job of the Social Security Administration. Our job is to lend you our experience and expertise in thinking about what's the way to maximize what you get out of this Social Security system in conjunction with everything else going on in your personal retirement plans and financial plans as you proceed into this phase of life. We are allowed to provide this advice to you because we are a registered investment advisor. Entrust Investment Services is our firm. We are licensed in all 50 states, registered with the Securities and Exchange Commission, and so we can provide this to you no matter where you live. Why is Social Security such a hot topic? Well, to put it simply, there are just so many folks who are qualifying for benefits every year. About 3.64 million new folks are still qualifying for benefits every year. That's been going on for the last 12 years. It's going to keep going for another 6 years. It's just a lot of people who are qualifying for benefits, Social Security, Medicare, dollars that they used to work and pay taxes into the system. More and more of you in this baby boomer generation are retiring, stopping the work, and now you're not paying into the system, you're pulling dollars out of the system. And so that, certainly and obviously brings up concerns about things like insolvency of the program. And so we'll touch on that a little bit. Social Security has become a very backbone piece of a retirement plan. If you'd ever attended a retirement presentation in your working years, maybe offered through your 401k plan or something like that, you probably were once told about the three legged stool for retirement. And the three legged stool for retirement consisted of your pension benefit, which we're seeing less of those all the time, your Social Security benefit, still available, still pretty good for many of us, and then the third item is your savings. Well, the one stool of pensions has been kind of kicked out of the picture. So, right now, 65% of retired middle income Americans are getting more than half of their retirement income from their Social Security benefits. And that happens for a lot of reasons. Obviously, for those who maybe haven't done a great job of saving or accumulating pension benefits, then Social Security is going to be a big portion of their retirement income. But even those who have done a great job of saving other forms of retirement income, whether that's accumulating a pension, real estate where they're getting rental income, for example, putting dollars into 401k plans or other employer sponsored plans or other just savings vehicles in general. Um, for even for those folks, because the benefits still exist, and I say that because you know, I think I've done this in live enough with people sitting in front of me to know that if we were sitting in a room together and I said, raise your hand if you heard, don't count on Social Security at any point in your working years, most, if not all of you, would probably raise your hand. And the reason for that is that the system is structured in such a way that they've run some risks of running out of money in the program a few times. And one of those times is coming up here soon. And so, that's one reason. But the other reason is, people want you to save also, save some money and get some additional dollars in addition to Social Security so that you're not solely dependent on this program. However, because the benefits are here and they are still quite good, the truth is many folks are getting more than half of their total income need from Social Security. It is not uncommon for me to do a plan for someone today. Let's just pick on married couples for a minute, where the married couples, between the two of them, their combined Social Security benefits is over $70,000. That's pretty common anymore. I'm seeing sometimes over 80,000 in combined benefits. So again, the reality is those benefits are still here, and in many cases it can be quite a substantial portion of folks' retirement income. Now, pensions going away, getting frozen. We've seen pension benefits reduced after they've started, unfortunately. All of that really began in 1985 and started to snowball to where today we have 84,000 fewer pension benefits in existence than we did in 1984. So, pensions going away has elevated the importance of those Social Security dollars. And right now, 46% of middle income Americans pass away with less than $10,000 to their name. This statistic is not here to frighten you. What it is here to do is to highlight one of the key important features of your Social Security benefits. You see, you insure important financial things in your life. Do you insure your health? Of course. How about your home? Absolutely. Your car? You bet. But do you insure your retirement? The answer for most of us is actually yes. Social Security, if you frame it in properly, how does this fit into my retirement plan? How should I be thinking about these benefits and what they mean to me as I'm thinking about my retirement plans, my income goals, my taxes? The way to think about Social Security is as retirement income insurance. You could also call it longevity insurance. The reason is that these Social Security benefits are guaranteed to you so long as you are still living. If you qualify for a benefit and you pass away with less than $10,000 to your name, whatever that benefit amount is that you are receiving, whether you have $1 million, $10 million, or you go broke, you are still getting that Social Security benefit so long as you qualified for it. So the way to think about this as retirement income insurance. That could be important because people are living much longer than they expected to. I don't know if you can live quite as long as this young lady. Ethel Caterham was born in 1909. She's currently the oldest living person at the age of 116. We'll see if she makes it to 117. The last few before her all made it to age 117. So it's been kind of the magic number for a while. Here's what we're going to focus on for the rest of the presentation. We're going to talk about some basic changes that occurred in Social Security law and just how the benefits are structured that affect everyone here in 2026. We're going to talk about some uh, some things that are specific to spousal benefits. which will lead us in a large way into this conversation about the cola fiasco that affects all recipients. This cola fiasco is not straightforward. You know, you may have heard cola standing for cost of living adjustment. We'll talk about it more in a minute, but that cost of living adjustment, yes, it increases your benefit, but there's increases in other domains that also take dollars away from your benefit. So we'll talk about that. I want to make sure you understand how that works. That will take us right into rules for those who are divorced or widowed, and then if you fall asleep somewhere in the middle, I hope you don't, but if you do, please let's do a little hypnosis thing right now. You will wake up in time for taxes. You hear me say the word taxes, and you're going to go, whoo. I'm not widowed or divorced, so I lost my train of thought, but I'm awake. Okay, so uh, I recognize that we can't cover everything that's super specific to everyone individually, so we do try to cover the key highlights for all groups. But the thing that will absolutely affect everyone in a major way, and I want to make sure that you don't miss it, is this issue very specifically of taxes. Social Security every year gives an update on what counts as substantial earnings to earn a credit. A credit is required, well, excuse me, 40 credits are required to qualify for a Social Security benefit. A credit is earned by having at least $1,890 of earnings here in 2026. That goes up every year, but not by a lot. You'll see that in 2025, it was only $1,810. So it's not that substantial of earnings that you have to get in order for you to qualify for a Social Security benefit. Now, that one credit earned per quarter means you can earn four per year. So you may have heard it said that you need 10 years of work to qualify for a benefit. Technically, it works a little different than that, but pretty much the math works out. Now, the way your benefit is actually calculated, Social Security takes all of your earnings over the last 10, 20, 30, 40, however many years you've been working. They take all of those earnings, they index them for inflation, meaning, money earned in 1985 is worth about 8 times that in terms of today's benefit calculation. So if I earned $10,000 in 1985, it's worth more than $80,000 when Social Security does the benefit calculation. Now, it's the highest 35 years, no matter when those years occurred. It doesn't matter if you did 10 years, took 20 years off, and then worked another 25. As long as you have 35 years of work history, it's fine. But what happens if you don't have all 35 years? Well, if you don't have all 35 years, Social Security will say, let's say you have 20 years. Social Security will take those 20 years, index them for inflation, but then they will add in 15 zeros into your benefit calculation. And so any additional work that you're doing today would be replacing a zero in the past and should have a decent sized impact towards increasing your benefit for the future. Now, if you have all 35 years already and you've been a pretty reasonable wage earner, you do have to have higher income now after those dollars have been indexed for inflation in order for your work today to increase your benefit when you file down the road. I think you know this, but if you don't, you have paid a lot of money into the Social Security system. 6.2% of your pay over the last 10, 20, 30, 40, again, however many years you have been working, that 6.2% has been going into the Social Security system. Your employer, unless you're self employed and then you get to pay both yourself, covered the other half of that for a total of 12.4% of your pay. I think if you could imagine an account somewhere with 12.4% of your pay in it, that'd be a lot of money. And if you even applied just a little bit of interest to that, Yeah, it's probably a nice big pile of money. The point is that this is an entitlement program in its truest sense. You are 100% absolutely entitled to these benefits. You have paid for them. But unfortunately, the Social Security system doesn't work like that. You don't have an account somewhere with your name on it with your money in it. The Social Security system is a pay as we go system, meaning if we have more money coming into the Social Security system than what's being paid out, we are buying treasury bonds with the excess and building up a little pool. But we have not been on that plan for quite some time now. Since 2010, we have been in the red, meaning that starting in 2010, we started selling treasury bonds because we didn't have enough money coming into the Social Security Administration to cover all current payments. So, pay as we go, where money flowing in is leaving right now to pay current recipients. And we did have a buffer of treasury bonds, but those are being spent down right now. We were fully funded through the year 2037. We're currently only funded through the year 2034. The reason for that is because uh, Congress passed a new rule, the Social Security Act 2023, and Fairness Act of 2023, and it said we're going to eliminate all of the things that reduced benefits for government workers who also have a government pension. That change cost the Social Security Trust Fund 3 years of solvency. So anytime they make changes to this system, it affects the bottom line and could affect what the system's able to provide to future recipients. We're funded roughly 77 cents on the dollar thereafter in 2035. It used to be 76 cents. We're not really sure what caused it to bump up just yet. Might just be inflation. But the point is, interest rate moves could be another part of it. But the point is that we did gain 1 penny. It's not enough. So, look, I don't want you to be worried about this. And the reason why I say that somewhat confidently is because the reality is that Social Security law says that once you reach the age of 55, your benefits are locked in. They can't change it. What does that mean, though? Well, you could look back in time, and I'm sure most of you know that your parents had a full retirement age of 65. Who here had a full retirement age of 65? None of you, unless, we have someone over the age of 90, I think, 80 something. But the point is that they all had a full retirement age of 65. None of you have that. You all have 66 and some number of months or 67. Probably most of you now at this point are age 67. That move from changing full retirement age from 65 to 67 was not immaterial because basically they're saying, hey, to get the amount that we promised you on your benefit statement for 40 years, to get that amount, you actually got to work a couple more years to get that full amount. You could file early, but now it's reduced. So you could retire at 65, you could file a benefit at 65, but the amount you get is going to be reduced compared to what you would have potentially been available to receive before the change. Your kids and grandkids are not going to see a full retirement age of 67, most likely. A lot of them are probably going to see age 70. They may take away the age 62 filing. So all of you could file as early as 62. They may say, no, not anymore. Now, they can't say it to you if you're over the age of 55. They can't tell you that, but they could say to your children and grandchildren, hey, we know we promised your parents that if they wanted to retire early at 62, they could go ahead and start Social Security, but not you. You have to wait till 65 now. So changes like that are the most likely outcomes, and Congress has to do something by 2034, or we have a problem. 2026 updates to uh, Social Security relative to what it means for the timing of when you file. So, I know that some of you may be old enough that you have a full retirement age of 66 and some number of months. But those of you who are in that group, you're already past your full retirement age. So, everyone who has not yet reached their full retirement age has a full retirement age of 67. If you file for benefits early, you can do that, but the amount that you receive is only 70%. So if I have a $2,000 a month benefit and I file at 62, it's only 1,400 or 70% that I'm eligible to receive at 62. Any month I delay, I get a little bit of an increase. It's a 5% increase for the first 3 years, and then it's a 6 2/3 increase for the 2 years after that. And then at age 67, I get 100% of my primary insurance amount. If I delay past full retirement age, I get an 8% simple interest increase every year for 3 years, taking my benefit to 124%. Or, said another way, instead of getting 2,000 a month, I would get 2,240, excuse me, $480. $2,480 would be available to me at 70. There are three distinct benefits that you could potentially be entitled to from the Social Security system. The first one is a retired worker's benefit. This is a benefit that you are entitled to based upon your own work history. Spousal benefits you could be entitled to based upon a spouse's work history or an ex spouse's work history. And then widow or survivor benefits are benefits that you're entitled to based upon a deceased spouse's work history or a deceased ex spouse's work history. Let's talk about some things relative to married couples. In order to qualify for a spousal benefit, you do have to have been married for at least 1 year. In addition, your spouse has to have filed their benefit in order for you to be eligible for the spousal benefit. So, in our little example here, if John has a $2,000 a month benefit, Jane is eligible for half of that or $1,000 at her full retirement age. She's eligible for 50% of his benefit at full retirement age, the amount of the primary insurance amount, not what he's receiving at the time. So if John files early, Jane's still eligible for $1,000 at her full retirement age. If John delays, Jane is still eligible for $1,000 at her full retirement age. But there's no increases past full retirement age for spousal benefits. There is the ability to file early as a spouse, but you can't delay as a spouse and get anything for it. Actually, you can delay indefinitely, but there's nothing in it for you. Social Security will not pay you any more money if you file at 67, 68, 69, or 70. Doesn't matter. For spouses, when one of you passes away, only one benefit remains, and it is always the higher benefit of the two. If John, in our previous example, filed Social Security at full retirement age, he's getting 2,000. Jane files at full retirement age, she's getting 1,000. Jane passes away. She takes her $1,000 with her. John keeps his 2,000. John passes away. Jane says goodbye to her 1,000. She keeps John's $2,000. Only one benefit remains. It's always the higher of the two. The only caveat to this is the 82.5% rule. The 82.5% rule says that if John filed early, let's say he was getting 70% or $1,400. So he turned his 2,000 a month into 1,400 by filing at 62. John passes away. The 82.5% rule says that Jane would not be stuck with the 1,400. She would get a little bump up to $1,650, 82.5%. Two most common mistakes we see married couples make. The first is that the higher wage earner files early and shortchanges the surviving spouse. So even if Jane gets that little bump up to the 1,650, well, John, in theory, could have delayed till as far out as 70, turning 2,000 to 2,240. So, or excuse me, 480. So that's $480 plus another uh, 135. So we're talking over $600 a month. $600 a month, that's 7,200 a year. That's every 10 years, $72,000, not including any inflation. And so if Jane outlives John, let's say, for that period, that's a hundred, for let's say 20 years, that's $144,000 of missed benefits simply because John filed early. In addition to that, Jane's going to lose her own benefit. So, let's say that was $1,000 a month. So that's another 12,000 a year. In 10 years, that's 120,000. That's 240,000 in 20 years. So, we're talking over 300, almost $400,000 of lost benefits simply because John passed early, but he also filed his benefit early. So if anyone's going to do any delaying between spouses, it's almost always going to be that higher wage earner. I'm not saying that's always going to be the recommendation, but if anyone's going to be recommended to do some amount of delaying on their Social Security benefit, it would end up being, in most cases, the higher wage earner. It almost never works out for both spouses to delay past full retirement age. This really comes just from my experience as a retirement planner. I can tell you often mostly for tax reasons, the tax planning component usually favors one spouse filing early to some degree or another and one spouse delaying to some degree or another. Okay, let's talk about the issue of COLA and make this a little bigger for you. COLA is not a linear equation, and that is because it compounds. When you take a compounded interest calculation, relatively small amount ends up being a much larger amount than you often expect. So the issue of COLA is not a small deal, it's a pretty big deal. In addition, COLA affects different filers differently. And the reason is this: there was a 2.8% cost of living increase announced for this year in 2026. What that means is that if you have a $1,000 benefit, that benefit is now $1,028. That $28 increase is the 2.8% inflation increase. But the problem is that Medicare also increases typically every year. This last year, Medicare Part B went from $185 up just shy of 10% increase, about an 8.5% increase, I should say just shy of 9%, to $202.90. So if you have a $1,000 Social Security check, you got $28 on the COLA, but Medicare took away $17.90 on your check, meaning your check only went up by $10.10. What does that mean to you in the real world? It means your real COLA is only 1.1%. But here's where it gets trickier. See, some people will say to me, I'm nervous about delaying my Social Security benefit because I'm worried the plan, Social Security, I just don't think it's going to last. I just want to get what I can out of the system. The challenge is if you live a good long life and you have a much smaller benefit, say closer to $1,000, this COLA issue is really hurting you. But look down below that. If you have a $3,000 a month benefit, the COLA increases your benefit by $84. Social Security doesn't go up as a percentage of your income, it goes up as a increase to the premiums required. So it's still only a $17.90 impact whether you have a $1,000 benefit or a $3,000 benefit. So you see that the person who has a $3,000 benefit gets $84 in the positive from COLA, minus $17.90 from the increase in Medicare. And so they're still getting $66.10 or 2.2%. The person with the larger benefit gets negatively impacted far less than the person with a much smaller benefit. So factor that in when you're thinking about your Social Security filing decision. It's very important, in addition to all the other things we're going to talk about, especially the issue of taxes, to remember that this issue of COLA is not straightforward. It's not transparent. It's not an obvious jump off the page issue, but it is a long term issue that can absolutely affect you over time. So you must keep it in mind when you're making this decision. Couple of quick things about those who are divorced. In order to qualify for a divorced spouse benefit, you do need to have been married for 10 years in a row to the same person. Married 5 years, divorced, remarried, even to the same person for 7 years, divorced. 5 plus 7 does not equal 12. One of those two stints has to be at least 10 years in order for the divorced spouse benefits to be made available. You may not be currently married in order to qualify for a divorced spouse benefit. If you had a spouse that you were married to for 10 years, you divorced them, maybe they had a nice income and you're thinking, maybe I could file off of their work history, get that spousal benefit. But you've remarried. That divorced spouse benefit is gone. It's now just your own benefit or the new spousal benefit. Same benefit amounts apply in terms of extra penalties. So spousal benefits, divorced spouse benefits, they reduce at a faster rate than your own benefit when you file early. In addition, there's no delayed retirement credits on divorced spouse benefits, just like there's no delayed retirement credits available for spousal benefits. The one major difference between divorced spouse benefits and spousal benefits is the last bullet point here. So long as you have been divorced for at least 2 years, you are independently entitled to file your divorced spouse benefit, whether your ex has filed their benefit or not. With the spousal benefit, in our example earlier, for Jane to get the $1,000 a month, John has to file his benefit. If they have been divorced for at least 2 years, Jane can get her 1,000 on her own timetable. She does not have to wait for John. Let's touch briefly on widow benefits. No rule changes on widow benefits here in 2026. You can still file as early as age 60. If you were married before the age of 60, you do have to remain unmarried before reaching 60 in order for the widow benefits to be retained. And you do have to be married a minimum of 9 months prior to the death of your spouse in order for those widow benefits to be retained. Now, that is there just to prevent deathbed marriages. It's not there to hurt anyone. So if you can prove that the person had no terminal illness, it was an unexpected death, typically speaking, you can get those widow benefits reopened. Let's talk about the earnings test. The earnings test typically goes up every year. You can see that in 2026, if you work, file Social Security, but are younger than your full retirement age. So let's say your full retirement age is 67 and you want to claim benefits at 65. Social Security will ask you, what's your earnings? They're asking specifically about W-2 or self-employment earnings. They're not asking about your pension check. They're not asking about your withdrawals out of your 401k. They're not asking about your passive income like dividend, interest, capital gains, rental prop. They're not asking about any of that. They're asking about self employment or W 2 income. If those figures go above in this year $24,480, Social Security cares. Last year, that number was 23,400. So you can see it went up a little bit, just over $1,000 increase. So it just means you could earn $1,000 more this year than last year. And Social Security doesn't care that you have the earnings and you're claiming Social Security at the same time. But the minute you go above that 24,480, Social Security cares. How much do they care? Well, let's say you have an income of $84,480. The first 24,400, Social Security doesn't care. They say fine. But you are $60,000 above the limit. 84,480 minus 24,480 is $60,000 above that limit. Social Security cares about $1 for every two above the limit. And so we chop the 60,000 in half, and you are ineligible to receive $30,000 of Social Security benefits. If the benefit that you're filing for is a $3,000 a month benefit, 3,000 goes into 30,000 10 times, meaning you will not receive a Social Security check in January, February, March, April, May, June, July, August, September, October. Then you will receive a $2,000 check in November and a $2,000 check in December, not 2,000, 3,000, excuse me. You'll receive a $3,000 check in November and December. Some people mistakenly assume that if you go above this earnings test, you'll still get a check all year. It's just a reduced amount. No, they simply do not pay you anything until you have paid back what you're ineligible to receive. Now, right side of this page almost never affects anyone, so I'm going to cover it briefly. In the year that you turn your full retirement age, but before you have turned your full retirement age, your earnings test goes up to 65,160. That also was an increase. Last year it was 62,160. And the benefit calculation is 1 for 3 above the limit you cannot get. Let's talk about this issue of taxes. Taxes is the biggest change from last year to this year. And it's not so much a change on the benefits themselves, but it's more of a change in how you would plan out your retirement income, especially thinking about other forms and sources of retirement income in addition to Social Security. And when do you want to time these things? Thinking about other tax planning strategies, such as realizing some capital gains to restructure things and get more tax advantageous income, for example, or restructuring some things so that you can do maybe some Roth conversions and get more tax-free money than taxable, either before or during or while you're taking those benefits. So this tax issue, there are some updates I want to make sure you are aware. The previous tax code, the one we were going to revert to, if that it is the official title of the bill. It's called the One Big Beautiful Bill. Okay, so that One Big Beautiful Bill is something that kept the Tax Cuts and Jobs Act cuts, but also added a couple of extra things. So we'll talk about that. Before that, if you were single, $6,350 was your standard deduction. The Tax Cuts and Jobs Act bumped that up to $12,000. And then this year, with all the cost of living increases, plus the fact that we got the tax code extended permanently, we're up to $16,100 for standard deduction if you're single. You'll see married couples, it used to be $12,700 standard deduction. In 2018, the Tax Cuts and Jobs Act bumped that up to 24,000, and now it's all the way up to 32,200 here in 2026. If you are over the age of 65, you get an old age increase. That's not my name for it. That's the official title. The old age increase, if you're single, gives you an extra $2,050 of standard deduction. If you're married, it's an extra $1,650 standard deduction each. So that's 3,300 of additional standard deduction available for married couples. This year, last year too, 2025, through the year 2028, there is an extra $6,000 available per tax filer. So for single folks, if you are over the age of 65, you get an extra $6,000 standard deduction. If you're married, you get an extra 6,000 of standard deduction for each of you who are over 65. So what does that mean? Well, actually, before we get to what it all means, a couple other things that are available now. The first is charitable contributions. Per tax filer, you can deduct $1,000 with no itemization required of charitable contributions. You don't have to itemize your tax return to get that $1,000 per tax filer. In addition, vehicle loan interest. I talked to a lot of people who are thinking about buying an RV. Or, they want to buy the car that they're going to drive, for their retirement years. Well, the point is right now, there are some limitations and rules, but if you buy an American made vehicle, you can get loan interest deducted off of your tax return. So many of you probably like to buy your vehicles without a loan, like to just buy cash. Well, there may be reasons to actually take a loan because now you can deduct that interest off your tax return. You have to be able to deduct at least $600 to do it. And the most you could deduct is $10,000 of interest per year. That means that if you are a single filer who has retired already over the age of 65, the maximum amount of income that you could get completely tax free you wouldn't hit a single dollar of taxes. You get the standard deduction plus the old age increase plus the bonus old age increase for 24,150 plus up to $1,000 in charitable contributions plus up to $10,000 in loan interest. So the maximum available above the line deductions income you could have with no taxes is $35,150. That first $35,150 completely tax free. Married couples, little higher. I will be updating this presentation next week because I'm tired of making my little caveat. It's actually an extra $1,000 from what you see here because it's $1,000 of charitable charitable deduction per person, meaning it's actually $59,500. So married couples, the maximum amount of completely tax-free income you can have is $59,500. Now, some of you may have heard that taxes was going to go away on Social Security. If you heard that, it didn't happen. There are still taxes owed on Social Security benefits, and the rules didn't even change. It's still just as complicated. Publication 915, which is what you're seeing on the screen here, is released by the IRS every year to tell you everything you could possibly want to know about how you'll be paying taxes on your Social Security benefits. Inside of this publication is this worksheet. This worksheet details out for you the 19-step process on what you have to go through, maybe better said, what your accountant has to go through or what your tax software has to go through, the 19-step process that will take you through and tell you exactly how much tax you're going to owe on your Social Security benefits. Yes, 19 steps seems like a lot, but that's because they made it needlessly complicated. Let me summarize some benchmarks that you can put in your mind that I think will be helpful to you. There's a magic number that you've never had to care about before until you filed for Social Security benefits. And that number is called provisional income. Provisional income is the combination of three items. Sometimes it's called combined income. So, whichever way you want to say it, provisional income, combined income, same thing. That amount is all of your adjusted gross income, earnings, 1099s, W 2, self employment, interest income, dividend income, withdrawals out of 401ks, pension benefits, annuity payments, doesn't matter. Any source of income that you have, part of your AGI, plus 50% of the Social Security benefits you're receiving count towards the number, this combined income number, that will determine how much tax you're going to owe on your Social Security benefits. Now, I've done this live enough to hear people shout out when I explain this, hey, that's double dipping. So if you're feeling like that, I get it, right? But that's part of it. Third item, if you have any municipal bonds, tax free interest. Yeah, it's federally tax free, but they take that number and they add it to combined income to determine how much tax you're going to owe on Social Security. So the IRS found a little way at that. If the total of that number, AGI plus 50% of Social Security plus tax free interest, if that combination for you is above $25,000 and you're single, you start paying taxes on Social Security. You could be subject to paying tax on as much as 84% of your benefit if that number is above $34,000. Married couples, when that combination of figures goes above 32,000, you start paying taxes on Social Security. When that number goes above $44,000, you could be subject to paying taxes on as much as 85% of your benefits. The question is, how much tax are we talking about? Well, let's say you're cruising along through retirement and everything's going pretty good. You've got Social Security coming in. You've got maybe some withdrawals out of your 401k plan coming in. Maybe you have some other source, some dividends or interest or whatever. Doesn't matter what it is. But the point is, you have this nice steady income and kind of covering all the bases and things are going well. But this year, you chatting with a spouse or a loved one or a friend, or you're just kind of thinking things through and you say, what did I retire for? Got some bucket list items, got some things I want to do. Maybe you want to go on a trip. Maybe there's something you like to see. I was talking to someone the other day who has a plan to, grab an RV and go see all the national parks. Love that stuff. But whatever it is, you're trying to figure it out and you're budgeting things, and maybe you want to upgrade something in the house. You've got a fireplace to repair. I have a client who's in the middle of that. You got the general maintenance stuff of the roof. That's not exciting. That's no one's bucket list. But the point is that you have this larger expense this year, and you're going, okay, no big deal. I mean, I save money. What I save it for? I saved it for me. And so let's say you're going to go on a trip, talk to your spouse or a friend, and you're deciding where to go, and you've got it all mapped out, and you're booking stuff, and you're throwing it on the credit card, and everything's getting done. And then, you take a look at your statement, and you go, "Ooh, wow, gonna have a good time. We're gonna spend $20,000 on this trip. That'll be great." So no problem. You've got the money saved. I mean, that 401k have been throwing money into it for years. You did all the smart stuff. You got your employer sponsored matches and that account has grown, and hey, lo and behold, it keeps growing. Markets have been a little crazy of late, but all in all, things are looking good. And so you get into the plan and you call them up and you say, "Hey, I need to pull 20,000, please, because I need to cover this trip I'm going on. They say they don't care. No, I'm just kidding. No, they answer your call and they say no problem, and then they ask you a very important question: how much tax would you like to have withheld? Oh, right. Yeah, of course. Yeah, yeah, you knew that. Right. Good question. Let me go look at my tax return. Maybe you're about to file your taxes and you kind of roughed it out. And so you kind of, well, I'm in the 12% tax bracket. No problem. They send you your $20,000. You go on your trip. Next year, you've paid off the credit card. Everything's good. Next year, though, you are punching stuff into TurboTax, or you've shipped it off to the accountant or whatever tool or resource you use to get your taxes done. I'm always sensitive to that because once upon a time, I had someone attend who worked for H&R Block, and I was said TurboTax only, and they were so upset at me. There's other tools. Anyway, you can file your taxes however you like. But the point is that TurboTax keeps saying you owe money. The accountant calls you up and says, "Hey, you didn't withhold enough taxes this year." What do you mean? I always withhold enough. The TurboTax thing, that's what I use. So I punch it into TurboTax and, it's got the red number and eventually it turns green. It's not turning green. It still says red. I owe money. How did that happen? What happened? Well, the software is not broken. Your accountant's not wrong. Here's what happened. When you took that $20,000 distribution out of your 401k plan, you were in the 12% tax bracket. So it was fine, right? $2,400, you paid it. Good. The problem is that when you took that distribution, you were above these limits that you see here on the screen. And when you're above these limits, when you take additional or have additional taxable income, it's increasing that modified adjust. It's causing more Social Security to become taxable. You're not getting more money from Social Security. You're just causing dollars that were previously not being taxed to become taxed. And the 20,000 taxed at 12% plus another portion of Social Security taxed at 12%, that effective tax rate could be as much as 24%. So you're in the 12% tax bracket, but the effective tax rate could be as much as double that. That's no fun. You pay the tax. Hopefully, you didn't get a penalty because it's a first time mistake. You're not going to do that again, though. So you cruise along through retirement. Everything's going well. You've done all the smart stuff. You get your expenses down. You want to make sure that you can take care of yourself no matter how long you live. You're not going to be a burden to your family. You're going to take care of things. And then one day you wake up and happy birthday. You are, for those of you on this call, it's either 73 or 75. Unless you're already past those ages, then you had an RMD sooner. RMD standing for required minimum distribution. When you hit 75 or 73, depending on your year of birth, you no longer have an option about whether or not you take money out of your 401k, 403b, 457, TIAA, TSP, IRA, simple IRA, SEP IRA, SERP plan, whatever these tax qualified dollars, meaning you didn't pay tax on those dollars when the money went in to the account. Now you must pull from the account. The larger the account balance, the larger the required minimum distribution. And for some people, unfortunately, I see this very frequently, that required minimum distribution is so large that, whoops, I'm not in a 12% tax bracket anymore. Maybe I've been bumped up into the 22% tax bracket. Now there's a portion of my income that's not being taxed. 12 and 12 is 24. It's being taxed 22 and 22 is 44% effective tax rate. These are the kinds of mistakes that unfortunately I see all too often simply because there was no pre planning done. Let's talk about a case study that highlights how important this is. Clients are 64 and 62. They have combined Social Security benefits of $34,000 if they both file benefits right away at age 62. They're going to start their retirement with about $752,000 in 401k and IRA assets. They will earn an average rate of return of 6% on that 752,000. Why 6%? Just keeps it really simple and easy to understand. It's a very modest rate. You can almost still get that with pure fixed income. 3% of inflation will need to increase their 70,000 year $70,000 a year of income spend by 3% per year to keep up with inflation. They will live to 86 and 89, respectively. In this example, if this couple files Social Security early, what you will notice here with the blue lines is that's their benefits from Social Security. The orange lines above the blue lines are the amounts that they're having to pull from their 401k and IRA accounts to meet their income goal, which is the red line sloping across the screen, increasing with inflation. The amount of the orange line above the red line is the amount that they are paying to taxes. You are noticing correctly that the amount of the orange line above the red line is not increasing linearly, it is increasing exponentially. And that is because of that double taxation process I described just a moment ago. Now, you'll notice here that eventually the orange lines go away, so they stop paying taxes, but they're also not even hitting their income target. They've gone broke. 14 years too soon. If this couple will simply modify their Social Security strategy, they're not modifying their retirement plans, they're just modifying their Social Security strategy. The the first 8 years is now being funded almost exclusively from 401k and IRA withdrawals. That's the orange lines there. But then look what happens when those Social Security benefits kick in for this couple. It's covering more than 80% of their total income need. And I don't know if you can see it there. There's a little bit of orange above the red line, but not much. It is not uncommon when we do pre planning for folks to put them in a position where they pay very little and sometimes even $0 in taxes simply for modifying, implementing some strategies. If this couple put Roth conversion strategies in play, they would definitely be tax free when those Social Security benefits kick on. Their portfolio, because they took all that pressure off of it, also lasts the remainder of their retirement. They do not go broke. If this couple optimizes their Social Security strategy, see the blue lines above the orange lines in the early years. Yes, they will pay a few extra dollars in taxes in the early years when they optimize their strategy. But look at all those orange lines above the blue lines thereafter. That is all the excess tax being paid simply for filing Social Security early and not optimizing it to the specific needs of their plan. The impact for this couple, they got $186,000 more out of Social Security over their lifetime. Their portfolio did not run out. It lasted the 14 remaining years of retirement. And even though they went broke when they filed Social Security early and they didn't pay any taxes for 14 years, they still managed to save taxes over their lifetime by optimizing their Social Security filing strategy. Few quick things about your Social Security statement. It does not do any future calculations on cost of living or anything like that. It assumes that you're working to the specific ages on your benefit statement. It does give you all the ages now, like 62, 3, 4, 5, full retirement age, 68, 69, 70. It breaks it out year by year now. I used to only do 62, full retirement, and 70. But the reality is what's not on your statement is, well, what if I work till 65? retire, go on Medicare, but maybe I delay Social Security a couple years. Just some of those details can kind of throw things a little off compared to what you see on your statement. It's your work record only, no spousal coordination, no widow benefits, no divorce benefits, and then certainly and obviously no advice. So, look, after hearing our presentation today, you may or may not feel that you could use a more specified individual analysis of your benefits, your decision, especially how this might affect you and play into the tax planning decisions that you have to make. If you're feeling that way, we are going to make available to you a free Social Security analysis. Now, if you are thinking this through, I'm sure that many of you are going, okay, wait a second. So I didn't have to pay to be here to get all this hopefully wonderful information, but I'll let you be the judge. But I didn't have to pay to be here for this. You're going to give me a workbook for free, and now I get a free analysis. That's too much free stuff, Kyle. What gives? Right. So let me explain that. Um, I'm sure we have Costco shoppers here. Our family's a Costco shopper, mostly because of the dog food option. Sam's Club doesn't have it, what we want. But anyway, I digress. Costco. I have 4 kids. When we go to Costco with 4 kids, especially on the weekend, because that seems to be sometimes when we can just fit it in, it's a nightmare. Going to Costco on the weekends is like the worst decision of all time. Why did we do this to ourselves? But there is one saving grace about Costco on the weekends, and that is that they have samples, right? Our favorite sample for our family is the grass. They never do it as a sample anymore. It must be popular. But the grass fed beef bratwurst, we tried it and we said, hey, oh, that's pretty good. We weren't planning to buy it, but that's why Costco gives samples. They say, hey, here's something that we think people will love. Let's give them a sample. They try it out, and there you go. They start actually picking it up if they like it. We feel about this analysis like the Costco sample. This analysis, in many ways, if I can be so bold, I'm sure for most of you is going to be more planning than what maybe you have ever had before. This is really a retirement income plan, is what you end up with. The reason why is because if you just say, well, what's my break even, my social security decision, and you kind of get a little nitty gritty about it, but you look at it narrow. The problem is you'll miss stuff. You'll miss the tax picture. You'll miss maybe how it affects you from an estate planning perspective. You might miss, hey, what does it actually mean for dollars and cents in my pocket when I'm factoring in cost of living changes over time? But the point is that all of these things are a part of this analysis. And if you decide that you would like to receive this analysis from us, there is no obligation to do business or buy from us. But our experience is that there are some of you who will see the analysis, will try it out. You'll say, hey, wow, this is really great. You did this for free? Then what else can you do? What other value could you provide to me? Our firm has an expertise very specifically in retirement planning and retirement investing. If you get this analysis from us, we are confident that there are some of you who are going to say, yeah, you know what, I'd like some help with these other items. And that's where we would actually engage you and where we would ultimately end up being paid. Okay. So the whole process to get the analysis is free. There is no obligation to do business with us. But again, our experience is that some of you will. If that's you, that'd be great. And here's what's in your analysis. You're going to get specific strategies about your Social Security benefits. We're going to look at a break even concept and make sure that you're not leaving dollars on the table simply because we're not thinking about the time value of money. And then probably the most significant portion of the analysis is the retirement income and cash flow, especially focused on the tax analysis piece. So if these are things that you think could be helpful to you, you're going to go to the same website, whether you request just the free analysis, just the workbook, or both. ssworkbook.com is the place that you will go. So you will go to ssworkbook.com. You can snap a picture of the QR code that just popped up to get there. I'm also going to put something in the chat for you to be able to get that. Looks like that is already going. So in the chat, if you're on YouTube, you should see a link that you could click. If you're on the website, you could also just open a new browser tab and go to ssworkbook.com. At ssworkbook.com, you are going to be able to request the free workbook. You're going to be able to request the free analysis also, if that's something that's important to you. I make 30 minutes for an introductory visit to go over the information that I need to put your analysis together. So that introductory visit is 30 minutes. If you will set aside the time, I've set aside time over the next 6 business days in order for folks to schedule a visit with me and to have that introductory consultative visit. We can do it by a Teams meeting. It will automatically set that up for us. If you've never used Teams and you would prefer to do it just by a phone call, that also, if you don't get on the Teams meeting, I do call you. But I will be on a video conference. If you'd like to be on the video conference, be happy to see you and meet you face to face. And we would engage that way as well. So either option is just fine. 30 minutes is the length of that initial consultative visit. It's going to be kind of a fire hose of information for me, from you, and you get an email with the types of things that you will want to bring to that visit. I do see that many of you are currently requesting that process now. If you request the free analysis, if you're just requesting the workbook, there's some feedback stuff. We really appreciate your feedback. I encourage you to answer those questions if you would. And you can do that now. You can also type in your questions now. If you have a question for our Q&A, I see we have a few in there already, so I'll go to those here in a second. But yeah, so with the Social Security analysis request, if you say you want that, it will take you to a couple more screens that will just help us pair you with the right process. So that initial consultative visit doesn't really change, but if you're willing to answer some of those questions about what you're most concerned about and just give us some general idea, that will really guide the focus of the conversation and kind of give us a heads up as to what is most important to you and what we need to be paying attention to. So we'll appreciate if you'll take the time to answer that. If you just want to get through the process and book on my calendar, you can do that as well. But we do appreciate if you take the time to answer some of those additional questions. Booking on my calendar should take you right to that. So please do that now. I don't have time to chase you down and find you. If you say you want to visit with me for the Social Security analysis and you don't book the visit, yeah, you're probably not going to hear from me. So if it's important to you, if you want to take the time to get the analysis, it's something that you will find helpful. Take the time to block off time on my calendar. Like I said, I've set time aside over the next 6 business days specifically for all of you. Okay, I'm going to start going to the Q&A portion. You can type it right on the website. You can also type it in the chat, Facebook or YouTube. Let me look back here. Okay, looks like our first question is, how about cops who retire with about 20 years of service only? Does the same apply for them? If you're talking about the elimination of the government pension offset and the windfall elimination provision, yes, it applies for them as well. Okay. I just got my Social Security benefit report and it says 70. Um, well, I'm not. Maybe if you are 70, then yes, the only benefit amount left would be age 70. But I guess I need some more details about that. Okay, we're asking for some clarification about the 82.5% rule. If John files early and Jane does not collect until full retirement age, does she continue to receive 82.5% of John's if she waits to collect her own? That's a good question, Tracy. The answer is yes. Good catch. You're smart. You paid attention. What happens if one spouse is on disability and the other spouse files? Can the spouse on disability ask, maybe ask for their benefits? I can't tell if that's part of the same question. Yeah, so this disability benefit is just the full retirement age amount early. So if that person passes, the spouse would simply receive at their full retirement age that amount, unless they both already reached full retirement age. Hope that answer your question. Okay. How is provisional income figured when one is retired and remains working? So, working is going to count as part of your adjusted gross income. So, it's not different. It's just, you have also that employment income factored right into your AGI and, counts dollar for dollar towards your provisional income. Okay. If you sell real estate, income real estate. I assume you're saying if you sell real estate and have a capital gain. If you're talking about that, I'm guessing that's what you mean. If it's not, just re-ask your question. But if you sell real estate and have a capital gain, it's just part of your provisional income for that year. It doesn't. It doesn't affect you for like the earnings test, for example. Okay. How old do you have to be to apply for Social Security? At least 62, unless you're widowed, then you get to do it at 60. Was divorced in April of last year. After 17 years, he is 69 and I am 65. So you're married 17 years. Can I still collect on his Social Security if I waive spousal support and opposite? Yes, yes. So all your other quadro agreements, QDROs, um, all of that stuff does not affect Social Security. So Social Security, you can get whatever the Social Security system entitles you to, regardless of any other agreements at all. Okay, someone says, I would love the workbook and analysis visit, please. Perfect. So I hope you went to the link. ssworkbook.com should take you right there. So we got several people who are booking. Okay, great. Okay, retired Coast Guard, former wife retirement income, referee, and umpire income. Recently let go from Walmart, turning 66 in February. Okay. Not necessarily a question there, but if you have one, let me know. Sounds like you have a lot going on. So if you have a specific question, please feel free. Like the workbook. Okay, great. Yeah. Hi, Joseph. 70 for full benefit. Yeah, you max out your benefits at 70. You cannot, yeah, it's not your full retirement age is going to be 67, but your maximum benefit is at age 70. Someone's asking me privately, so I won't say your name. I'm undecided about the analysis. Can I reach out tomorrow or Friday? I believe that should be okay. Obviously my calendar fills up quick, so just as soon as I'd get in there and get it booked. But yeah, just that's where you go. Someone popped their address into the chat. I would not encourage you to do that. It's probably just fine. But if anyone is would like to send a friendly note to Anchorage, Alaska. All right, we'll just move on. Okay. If there's something you're wanting from that address, you got to go to ssworkbook.com if you're trying to request things. Okay. How does this work? I've been separated for 6 years from my husband. He lives in Michigan and I'm in Pennsylvania. Well, so technically you're still married for Social Security purposes. So that's how it works. You got to treat your benefits like married benefits. You don't get to treat them like divorce benefits. When you were talking about 401k, you were saying it's best to start using it before you retire. Not exactly. You almost got it. So, what I was suggesting, at least for in my case study, was that it was actually better for that couple in the case study. And this isn't true for everyone. So, let's just be clear as one example. It doesn't always work out this way. But in their case, they were better off using the 401k to fully fund those early years of retirement and then delay taking Social Security till later. And the primary reason was tax. There were tax reasons for that. Okay, I'm 72 years old, currently married. I have a divorce pending. I retired under CSRS, okay, was not eligible for Social Security in my own right. Once I'm divorced, can I file on my previous husband's Social Security? Yes. Oh, the prior spouse who passed away. Yeah. So, how old were you when you remarried? Because you have to stay unmarried prior to the age of 60 in order for widow benefits. Well, no, there's some complications. So, you're getting a divorce now. The answer is probably. I got a strong probably that you could file. Um, yeah, I'd have to think. I'd have to get a little more details just to get full clarity on that. But I believe the answer is yes. You should be able to file for widow benefits. But you're already 72, so are you already getting either your own or a spousal? Because that widow benefit would have to be more than your own for this to be relevant. So if that's the case, then yeah. But if it's not, then I don't know. I don't think so. Okay, after collecting on an ex's Social Security, what happens if he remarries? Well, then they could get so the ex could get Social Security from him. You could keep collecting on his, and he can get his own benefit, and that's all fine. It all works. Okay. Husband failed claiming Social Security at disability at 62. He's been diagnosed with Parkinson's, so he's forced to claim his SSA to pay his mortgage and family. Okay. Can Social Security owe him the disability benefit and can it be claimed now? So, Social Security disability is something that, um, the disability benefit is something that you would file for. And from the point, from way back when he first filed and was rejected, they would have to back pay if he eventually gets qualified. I hope that answered your question. Okay. I will need to call for an appointment and the analysis, please. Are you Pacific Standard Time? I'm in Eastern Time, but I have a couple days. I do know that I have many folks who are out on the West Coast. And so you should see on my calendar, I have a couple of days where I do work late Eastern to accommodate those of you who are out on the West Coast and, maybe still working. Okay, I'm going to take a question someone put in YouTube. Billy Scott says, should I start converting thrift savings? Should I start converting thrift savings plan to Roth TSP? I'm 66 years old and am I limited on 8,000 a year? No, no. If you're getting the analysis, this will be super helpful to you because you're asking all the right questions. But you don't have any kind of limit. It's not like contributing to a plan. A conversion, you could do as much or as little as you want, but you can't do it inside of the TSP either, right? So you have to go to an IRA to then go to the Roth. So there's some logistical challenges with what you're talking about, but you have the right thought process. So thank you for that. Good question. Okay. Does Medicare come out of Social Security? Yes. Yes. I'm retirement poor, turning 68 in April, not collecting. When can I file and get benefits and be avoid being put on Medicare? I will be married in July and most likely put on TRICARE. Um, Let me see if I can answer that with just the details you gave me. Yeah, when you file Social Security, you're automatically enrolled um, in Medicare. I assume you've been working, which is how you manage to not claim Medicare at 68. Even TRICARE still makes you go on the basics for Medicare. So TRICARE does not, I mean, you still have to go on Medicare. So I don't think avoiding Medicare is gonna work. Not sure if that answers your question, but hope so. I'm seeing workbooks for young school students. ssworkbook.com. I'm going to the site now. No, there shouldn't be anything. I think you punched in something wrong. It's just SS, like Social Security, workbook, not workbooks. Make sure there's no S on it, but ssworkbook.com, and it should take you right to our site. So if you're seeing something for young school students, you're on the wrong site. Okay. You just look through here. I think we've got everybody. Okay, great. We finished right on time. So thank you all for being here. Really appreciate your time and attention. Do encourage you to request the free workbook, request the analysis, and I look forward to interacting with all of you here soon. That free workbook will be emailed to you, so look out for that. It should be coming soon. And with that, I'll wish everyone a good night and thank you again for your attendance. And if I'm going to see you face to face, I look forward to interacting with you then. Thanks, everyone.